Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. We got a good one today, folks. Give me a like and a comment to show me you love me. We'll start with the ETF flows from James at CoinShares. Another 2 billion, another 2 yards. That's what we love to see. Just a continuous global demand from anybody. Doesn't matter who. If it's Saylor, if it's corporations, if it's ma and pa, if it's grandma's pension, whoever, doesn't matter. And that's the beauty of it. Ethereum did have a nice little uptick there last week, considering it's been rather slow relative to BTC and ETH. And that's also what you need to see on the Ethereum side for things to start to move a little bit. Looking at the 30-day cumulative flows for BTC, we are definitely ramping up here, just as we were in March. And again, contrasting this to 2020, we don't need 2 billion a week, right? I'll take a billion a week. I'll settle for a billion a week. Saylor bought 4.6 billion allegedly, even though nobody can see that on chain. I'm not saying he didn't. It's just a little odd that he bought twice what the global ETFs bought, and it doesn't really seem to feel like it. But price-wise, the best thing here is to just normalize some sort of cumulative inflow without giving it all back, right? We get these like fits and starts of people who get very excited for event-driven reasons, whether that was ETFs themselves or the election. And now we may have people asking, okay, what's the next event, right? This is why I prefer trend strength versus these bursts of buying that sort of come and go. Looking at BTC positioning from the COT data, this is Jason at Crowder Market Report. The positioning is what you'd like to see. You want to see commercials very long. You want to see large spec very short. You ideally want to see the yellow small speculators also short. But we got the turn, we got the flip from commercials being short to long in September into October. They got longer. Large spec got shorter. It doesn't matter if this is basis trading. It doesn't matter what it is. As Jason will tell you, it doesn't matter if it's ARB or not. This is what you want to see. So positioning still looks fine. Price looks a little tired up here as we're kind of giving back 90 today after tapping 92. Price looks a little tired. So it certainly looks like we're going to need a little bit more consolidation. Like I said, Saylor bought his largest buy ever, I believe, 4.6 billion. Nearly 52,000 BTC. And based on MSTR's premium to NAV, I would just keep doing it. If I were him, why not? Just keep buying. That's what the people want. Give the people what they want, Saylor. Looking at the MSTR chart, the pitchfork, the cloud, nothing says this can't keep going up forever. That's, of course, what the MSTR people will tell you. Me personally, I'm still out of any position as of last week on MSTR. I don't think we'll get 250. But if BTC mean reverts to its daily Kijun equivalent, then MSTR will certainly get pulled down a little bit. So I'm definitely being patient on that front. Before I talk about some more macro stuff, let me mention today's video sponsor, Kraken Pro. Kraken Pro is the complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. On the old BTC, very similar pitchfork placement as MSTR. Similar story here. It's overbought-ish. Doesn't mean it can't keep going. It just means the best risk-reward trade was clearly the breakout. We've reached the expected target. And now we find out what's next. So the read isn't bearish. It's just how much more can we expect necessarily in the near term. Over the weekend, I was watching this inverted head and shoulders possibility, which never really broke down. And now it's sort of morphed into an ascending triangle or something. It's kind of all over the place here. What I'd really like to see is either the 1 hour or the 4 hour cloud just completely reset. And this would take probably a week. Probably take us into December. I don't know if we'll get that, but I would certainly feel more comfortable seeing that. Again, nothing says we have to do anything other than keep going here. That's totally fine. But it does feel a little tired. A little tired. Alts have done a little bit better today because BTC has done a little bit better today. Tezos randomly up 60%. We're almost at the part of the cycle where it's buy anything that hasn't gone up season. I think HBAR was up 50% at some point today. Stellar was up 25% at some point today. Memes have certainly cooled off. Ripple's cooled off a little bit. And we're seeing the rotations play out. ETH starting to wake up a little bit. ETH beta like Link waking up a little bit. DeFi waking up a little bit. And Sol still kind of stuck at that 240 range. But overall, everything looks okay. I just, for me personally, want to give it a little bit more time up here. Schedule for the week is simple, not really much going on. Some Fed speak. Really the big thing is NVIDIA earnings on Wednesday, which at this point, I don't know how big they are necessarily for the market. They're certainly big if you're in chips or if you're in NVIDIA, but I don't know how much Bitcoin is necessarily going to care about the NVIDIA earnings this week. On the Fed meeting probabilities, still favoring a 25 basis point cut. The cutting cycle has gotten less aggressive into 2025. And the big question here is, of course, how does the Fed weigh unemployment versus inflation? Does unemployment creep up beyond 4.1? Does inflation creep up beyond 3.5? And how does that affect the Fed's easing cycle? But even though we're not pricing in as many cuts as we were, we're still pricing in cuts just much, much slower than previously. Now, of course, Trump could go in and blow up this probability matrix completely and just cut rates significantly with his shadow Fed governor or whatever he wants to do. But this is where we stand at the moment. On trueflation, we are now higher than 2.6, which is the US government reported number. And if we back this way out, we're getting dangerously close to this new level of like 3 to 3.5. If we look at the UK is kind of already there at this new 3.5 level. So globally, it may be harder to keep inflation lower as long as debt is as high as it is. Now, we all know Trump wants to come in with Doge and cut a bunch of jobs. It's going to be interesting if that helps trigger a recession. Not that austerity isn't needed. It's just you're cutting jobs, right? You're cutting jobs and you are deporting people, and that could be problematic. That could tip the apple cart. I'm not saying any of that is not needed. It's just the reality of what we may get on the back of that may get ugly, but that's a 2025 conversation. We do have CPI expected to creep up. We're now 18 days into November. PCE also creeping up. Everything's sort of slowly headed in the wrong direction. Now, in the grand scheme of things, this isn't 10. It's not 18. It's not as bad as it was post-pandemic. But if the new normal is 2.5 to 3.5 versus 2, then that means bond yields have to go higher to become more attractive. And that potentially means risk gets less attractive. Now, if everybody just says, all right, enough's enough, we're going to just avoid bonds entirely and go straight into risk or gold or Bitcoin, then maybe we end up okay. But if the 10 years above 5%, I think we run into some issues. Individual components of inflation, this is the US used car index. This is the pre-pandemic trend, and you can see we're definitely nowhere close to the pre-pandemic trend on the used car index. We have come down considerably, but definitely not close to the pre-pandemic trend. Energy has come way down, and if we're going to drill, baby, drill, then energy is probably going to continue to come down. Gas prices probably going to continue to come down. And this is the lowest gas has been since at least 2021, if not before. I wish they put 2020 or 2019 on here just as a comparison pre-pandemic. But for people who pay for gas frequently, this has been a nice reprieve for them relative to the past few years. Looking at the fertilizer index, again, thinking about like food costs, this has also sort of reached a new equilibrium post-pandemic. This was the pre-pandemic ZERP era, and now we are, let's say, the equivalent of like 3.5% on CPI, right? This could just be the new normal, and it is what it is. Most of the CPI or core or PCE components that are still elevated are services, and I don't think anyone sees that coming down anytime soon. GDP looks fine. It's sort of flatlining up there at 2.5%, so no issues there. On the liquidity front, it's been problematic that the dollar has been rising for global liquidity in the green there broke out and then came way back down. US liquidity continues to dwindle, and we're kind of fighting against all that on the crypto side. Altcoin market cap jumped a lot. BTC market cap, stablecoin market cap, all those have jumped in the face of global liquidity moving lower. We also know the reverse repo is starting to run out. If this runs out with bank reserves below an adequate level, then that may cause the Fed to flip from QT to QE, but we sort of have to wait for that to happen. We can't necessarily predict it. Now, if reverse repo is 0 by December, then they may do something. If it doesn't hit 0 until February, they've got some time. But what they don't want is a liquidity crisis on their hands, which would certainly hurt the banking sector. I talked about DXY, 10-year, and oil yesterday. DXY's come down a bit from last night's open. 10-year yield also down slightly, 4.41, and then oil bouncing a little bit. So I think this is like a healthy equilibrium for the market that so far is tolerable. But if the 10-year goes to 5% or DXY goes above 107, then we get to see what we're really made of. Is that what it's going to take to mean revert BTC, for example? It would make sense to me if we see DXY breakout higher and then we see BTC lower. That would make a lot of sense to me, but no guarantees we see any of that, obviously. Looking at the yield curve, the red line is today, and this has slowly been normalizing. So what you'd expect to see is the opposite of what we saw with the inverted yield curve. You expect the lower end rates, or rates at the low duration, to be lower than the 10-year, the 20-year, the 30-year. So we're slowly normalizing that out. The 10-2 curve is still, as you'd expect, in uninverted, so that's good. Unemployment we get at the end of the month, so we got time on that, and another cut on interest rates, potentially not until December. So far so good on this. Now, a lot of people are, of course, concerned that this would be suggestive of a recession, along with the 10-3 curve, which is getting more and more uninverted by the day. And I'm not going to disagree, but so far GDP looks fine. Now, it would be interesting if the next administration starts deporting immigrants and cutting government jobs, and then we have some sort of recession on top of that. That would just make sense based on the data. So we'll see what actually happens, because the data would suggest, if you believe in yield curve flipping from inverted to uninverted, that's when we typically see the recession, and that would certainly be within the next 4-year time period. So first step, it'll be interesting if that happens and what the ramifications are, and then who the next administration blames for a potential recession. Looking at the bond complex, the ETFs, TLT, IEF, SHY, and AGG, none of these look inspiring to me. I've had a lot of people ask me about TLT, and again, it's simple. I'm a trend trader, and I'm always looking for the same thing. I always want one thing, and that is a bullish Kumo breakout or a continued bullish trend, and we don't see that on any of these. So what I like right now are just short-term treasuries, either BIL or BILS or SGov or whatever the equivalent is for very, very short-term US treasuries. The duration risk here doesn't really make sense to me. None of these look good on trend. And at this point, you may as well just eat the Bitcoin volatility and sit in 1x BTC, because you're just losing money, right? So it really doesn't make sense to sit in any of this stuff other than the short term, in my opinion. Looking at gold, it looks okay. It's not an entry for me on the long side. The entries were in March, and then the re-entry was in July. What you're looking at is the end of a run from July for gold. This doesn't have to roll over to 0. It doesn't have to go below 2,000. It doesn't have to completely go off the table. But as far as a trend trader's viewpoint here, you would have been out of this somewhere probably 2,700 or 2,600 based on Williams fractals, which I don't have on the chart here. But you had two great, healthy spurts of action here on gold. And the next thing you're going to want to see is what we've already seen many times this year, is a TK recross with price above cloud, or a full reset of the cloud. That would take you into 2025 for what I would want to see as a trend trader, or at least until December. So nothing here on gold says this is just a screaming buy. Other than the TK cross, you'd want to see a Kumo sorry, not a Kumo bounce, but a Kijun bounce, the red line here, which you don't have. So within the next couple of days, you're going to get a bearish TK cross, which is an exit signal based on the trend. BTC against gold, almost at a new all-time high. Almost at a new all-time high. So I'll take my chances with BTC relative to gold there. S&P looks fine. Again, this isn't like screaming bearish. I think people last night took me as being super doomer. All he was saying is if things start to break down, at what point does BTC start to pay attention? S&P looks fine. It's had quite a run since January, and it just doesn't look like an entry up here for me based on my rules. Again, you'd either want to see a Kijun bounce at the red line or a full cloud reset similar to November into January, or a TK crisscross, which we're nowhere close to any of that stuff. So nothing here really makes sense to me. BTC against S&P, almost at all-time highs. I'll take my chances with BTC. The Q is very similar. Not much going on here. It looks fine. It just doesn't look like there's momentum or there's a trade for me here. You can see from level to level, breakout, TK cross, breakout, TK cross, breakout, TK cross, breakout. We don't have a TK cross yet, but we're in the back fifth, the back nine, I guess, when we want to go with the golf metaphors of this move based on trend metrics for the cloud. So I really don't see a great entry here. We've also got, again from Jason at CMR, we've got the opposite positioning for what you'd want to see on the bull side. We've got commercials, very short, large spec, and retail, relatively long. So it's just going to be harder to push this higher, most likely. Doesn't mean it can't go higher. It just says this is not what you want to see. And it makes sense that since July, we've kind of gone nowhere because commercials haven't been helping. They've been hurting, they've been hedging. So positioning data doesn't really look great for the NASDAQ. And then if we want to do jet fuel against jet fuel here, BidX against TQQQ, this favors BidX still. And, that's a 2x product against a 3x product for TQQQ. So I'll take my chances with Bitcoin. Now to the individual stuff, where I'm definitely bearish is Microsoft. I've waited and waited and waited for months. We've been watching this, and you've got several head and shoulders fractals stacked upon one another now. You've got price losing the cloud, below the cloud. People often ask me for BTC, what do I want to see to get out of the market, to be bearish? The moment we start losing the cloud like this on the daily, that's when you know you're in trouble. If you start to lose the cloud on the weekly, you are especially in trouble, which is what we saw into 2022. That's the correct time to be bearish based on trend. But what we're seeing here this week is a bearish TK cross, the first one since 2023. So what the cloud is saying here is if you are long since 2023, this is a great time to get out. That's what it's telling you. It doesn't tell you if this goes to 340. It doesn't tell you if this goes to 600. All it's telling you is that momentum has slowed down significantly enough that it doesn't like the long side here at the moment. And based on the chart pattern, I'd agree. What you'll notice is chart patterns in the cloud are pretty good at picking out reversals in trend. So I can't get bullish on this until the cloud is bullish or until Microsoft is back above 450. The weekly cloud target at 340, let's say, also matches the expected measured move here. So just not a lot of bullishness coming out of Microsoft. Now, if this was a pair trade, Amazon versus Microsoft, it's Amazon all day. Uncle Jeff, I think, is done selling at this point or has less to sell than he did last month. But over the next couple months, I certainly like Amazon's chances based on cloud positioning, based on potential cup and handle here, whatever, for highs rather than Microsoft. Tesla's done very well post-election. It broke out of 270. That was the key level on the inverted head and shoulders. To me, it's just not worth having to deal with headlines on this thing. But it looks like an eventual move above 411 is in the cards. I think if this gets back to 270 for whatever reason, that's a great neckline retest, which seems impossible up here. But it does look like eventually that one's headed higher. NVIDIA has really cooled off, which is probably warranted considering how hot this thing was running. After the breakout at 130, it's kind of gone nowhere. Earnings are this week. I'd imagine it does well post earnings just because that's the trend. The trend is it just continues to beat and beat and beat. This still has a measured move to about 180, but it feels like everyone's playing a different game now. They're not really playing with NVIDIA as much, at least that I notice, just based on the volatility. They're playing, options on MSTX versus options on NVIDIA, or MSTR versus NVDA. It just feels like the volatility game has gone elsewhere for now. When we look at SMH, very similar to that weekly Microsoft chart, this thing has tried to break down for a couple months now, has been unable to, but has never once looked good to me. This just has always just looked like a head and shoulders ready to break down. It hit the cup and handle target and then some, and it's about to lose the cloud here. So as a sector, this just trade looks like it's done. It's over, right? To me. Not saying this can't move higher, but what would I rather trade? This or IGV? IGV all day. SMH or XLE if I can find it. XLE all day. These are fresh breakouts. These might be boring. These might go nowhere. These might fail. This idea might crumble, etc. But from a technical perspective, why force a trade on this? It just doesn't make sense to me. The cloud is not on your side. Chart pattern is not on your side. And it's already had a great run. It's up 2x since 2023. Still. So I just feel like there's better places to go with your money. IGV being one. This is software. Still looks fine. That's a cup and handle breakout. No real comments there. That has plenty of room to run. And then there's stuff like Square. Would I rather trade Square or S&P? Would I rather trade TOST? Probably not. Or Square. I like things that are ready to go. It doesn't feel like I missed the train trading Square, where TOST at this point, the move certainly looks like it's in the later stages of what you'd expect to get. You have a cloud shelf here at 40 or something, which is the 50% of the down move. This could reconsolidate, continue markup. You've got Wyckoff stuff all over this, et cetera, et cetera. But if we're talking about trades today, yeah, I like Square over just about everything. If you're curious on a fintech ETF, a lot of people have asked me about this one. FINX is just an example of one that has done very well. This feels a little late to me. Again, relative to Square, pre-breakout, looks good at the neckline, has spent multiple years consolidating. I've seen a ton of people talk about Square on the legacy side because of how good it looks. So I like that a lot. There's like 10,000 things you can trade. Why try to force a trade on SMH? This is biotech. Biotech has given back a ton thanks to RFK potentially being HHS. And again, it's just like, why? Why force a trade on this? There's other stuff. There's other fish in the sea. It just makes sense to avoid this for now and trade stuff that looks like it's ready to break out. And maybe one of the best ideas is to just track MSTR BTC, which also looks like it's on its own Wyckoff journey here for markup. Chart looks very good, undeniably. Would I rather trade this or TOST, right? That's close, but probably still MSTR. Looks very good relative to BTC. SMLR is another one. Poor man's BTC. Similar to Square, similar idea. Looks very good. It's gone nowhere for multiple years, and it's finally starting to catch a bid thanks to the BTC Treasury strategy. Hood is another one that a lot of people ask me about because I was beating the drum in 2023 on this thing, and it just feels like most of the move at this point has happened. So you're either holding this just in perpetuity, or you're just trading other stuff, right? Would I rather take a fresh trade on this or XLE? This or Roblox? I prefer stuff that is ready to break out or freshly broken out. So it's a little late to do anything up here for me on Hood, even though the cloud does like something like 50, which is a decent move higher still. Coin is another one. It looks better than most of the miners. I don't think it looks better than BTC, but it looks okay. I guess if you're bullish ETFs, if you're bullish custody and base, I don't know, right? We can make up reasons to be bullish on coin and justify it. The chart looks fine. It doesn't look tired. It doesn't look bearish. It does feel a little late on the breakout here, but all in all, there are worse things to trade. Roblox still looks fine to me. For higher, eventually the cloud likes, 85 or 84, based on the 50% retrace of that. And then lastly, I'll just pitch XLE again. Took a trade on this earlier in the year, went nowhere, got out. It has a low time frame inverted head and shoulders there. It's still qualifies as an ascending triangle breakout. We'll see if this is a Trump trade or not. But I like the tech, and I like this certainly better than SMH and most everything that's out there right now. So that's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.